Good morning. Welcome back to the broadcast, Retirement Network. I'm Jeff Snyder. This is BRN Weekly for Saturday, October 2nd, 2021. And here's our top story. The reconciliation bill potentially rolls back significant retirement gains. Joining me now to discuss this and a lot more, Henry Yoshida is the founder and CEO of Rocket Dollar. Henry, great to see you. Thanks so much for joining us on the program this morning.
Hey, thanks a lot for having me. Appreciate it.
And we're going to talk about this long and winding road that we call a reconciliation bill, but specifically, let's talk about the impact to IRAs, and it significantly impacts your business. So what can you tell us? What's going on here with IRAs?
Yeah, so obviously your audience may be aware that there's a lot of proposed provisions, and I guess that's exactly what they are right now, to change, I guess, the rules that have been in place, or sort of the give and take understanding between regulators and tax deferral treatment and the consumers who invest hard-earned dollars into IRAs. And some of those are being threatened right now. Maybe the rules are being changed midway through the game and so forth. And some of these proposed provisions do directly affect a portion of our business. But, the bigger, broader thing to me is that I think they're going to directly impact negatively people's proclivity to save and be great investors. I mean, I feel like for your entire career, Jeff, and mine, we've always been, pounding the table, trying to get people to save more money, invest more money, and the rules have been created as such. And we've actually gotten to the point where we're no longer at the bottom of the cellar in terms of developed nations and our savings behaviors. And now we're about to change that and probably go back the other direction.
And let's talk about that, because I know that they're talking about, first of all, raising taxes, and that's how they're going to pay for this $3.5 trillion bill, whatever the number actually comes out to. And they're going to do it on the backs of, savers, as we're talking about. And I know that they were talking about capping, so anything over a certain amount in terms of a balance would be taxable or subject to some kind of tax, whether it's capital gains, whether it's ordinary tax rates, whatever. I mean, that just, to me, is such a, $5 million isn't a lot of money in the scheme of things if you're living 30 years, Henry.
Right. Or if you've had these accounts, right? And remember, think of the tried and true great, financial advisors have been given advice and saying, hey, start these accounts early, start at X% of your income. And let's just say that is to start first job out of college, roughly 21, 22 years of age, start at 10% of your income. And then you have an entry level salary, hopefully stair-stepping up based on merit and as you move through your career. Well, that behavior alone in just a very sort of normal 8% per year return S&P 500 index fund and nothing else is probably going to get you to this sort of $2 to $5 million level in your account if you start at those ages and do exactly what we've been told to do, what probably our industry is actually hammered into everyone's heads to do. And it's not a lot. So these caps are just, even if people don't hit these caps or they get really close to it, I just feel like you're basically taking this end goal and changing the provisions and rules of that. So at which point I think you're going to go in reverse. And a lot of people are going to say, well, in that case, why should I even try? I mean, the end of the race isn't going to be great. So why join and start this? And then I think we have bigger economic problems if that becomes the attitude.
I completely agree. And I think the thing that it doesn't factor in, Henry, is inflation. Let's talk about inflation. I mean, you have a car, I'm assuming. You take your children to school. You have to get gasoline. You're paying for goods and services. The rate of inflation on a lot of core goods through the roof. And we know that the cost of healthcare, especially for people who are going to be retired, is only going up. It's not like it's going down. So the buying power of a $5 million account sometime in the future is going to be a lot less than $5 million today.
Exactly. And we all know that maybe some of these rules haven't necessarily always been indexed to inflation right now, including, let's say, the status that they're threatening for some of these qualified investments in an IRA. That's never been indexed for inflation either. But you're exactly right that for me, I feel like the customers, the people I've worked with throughout my career as a wirehouse, a retirement plan consultant, then an RIA fee only consultant, and then of course now through two fintech companies concentrated in this IRA space. I could pretty safely say that actually none of my direct clients have ever been billionaires who I think have proactively tried to avoid taxes, but they've actually been that realm of exactly what the prototypical great super saver informed investor work really hard and put away a portion in consistent amounts over a long period of time. And it's just going to disincentivize a lot of that. And of course, as you just said too, that these caps are just being picked at pretty arbitrary levels, I think, too, that will more negatively impact millions of people as opposed to probably rightfully capturing money owed from less than 50 people that they want to target.
Yeah, they should just target those people. I mean, and by the way, those people are investing in places that create jobs and build factories and all the other things. I mean, it's just in my opinion, a hard case to make. But Henry, specifically to the self-directed IRA, let's talk about the impact to alternative investments. And by alternatives, when we had you on the show, I think it was last year, you talked about what Rocket Dollar is doing and that people can invest in private markets, private equity, hedge funds, I would assume Bitcoin and cryptocurrency. What's the impact there to being able to buy those types of investments that you and I, unless you're a gazillionaire and at the very top of the accredited investor list, I wouldn't be able to buy a hedge fund, at least not a good one.
Right. Well, first of all, this is, I guess this is a news network too, so it's news. So you are not a gajillionaire. Okay, so now I learned something.
Okay, there you go. Before. So no one hit me up for any donations. I'm just trying to put it all into BRN. But anyway, thank you. That is a news network. That is news.
Well, and remember, so some of these ways that they're structured, these private equity, private venture, and maybe direct investments into what is typically characterized as an angel investment, what is typically dollars going into a technology early stage company. Those investments would be impacted because you have to make some sort of attestation or meet some sort of qualification, whether it's educational or money-wise, to go into those investments. So right now, those are being threatened in the self-directed IRA space. So that's a big part of it. Let's just say that that's probably half. Oddly enough, cryptocurrency, for the most part, is probably more volatile and maybe even to a certain degree more risky than some of those private type fund investments, because it's a fund by nature that's spread over multiple investments by definition, yet does not require any sort of attestation. So those would actually still be allowed. And then real estate, which typically is actually higher dollar than maybe the minimum commitment into a small private equity fund that's available to a self-directed IRA investor, is at a higher dollar amount, yet that also doesn't require you to attest or be qualified in any sort of way. So those would still be allowed. So I kind of delineate these down into maybe three segments, one of which will be directly impacted. But that one that you're going to directly impact, when you say private equity, venture, and private business investing, I think right now regulators are misconstruing that this is the way that billionaires become wealthier and become multi-billionaires, for example. And I think what's being lost is that actually many of these investments, these private funds, are actually concentrated in very hyper-local geographies and directly, in a lot of cases, contribute to infrastructure. I mean, most of the ones that we have in our customer base are actually going into small private fund real estate deals locally. So these are not, Facebook intended type investments. This is a multi-family apartment complex for a $2 million equity raise, split into $50,000 units, 40 units in some area, let's say a suburban area of Austin, Texas, where I'm based, or Cincinnati, Ohio. I saw one last week for Knoxville, Tennessee, even, and so forth. That's direct infrastructure investing, and that's being threatened as well.
Yeah, it just seems like, I don't know, when it comes to these broad bills, and there's a lot of stuff stuffed in there, and it's like horse trading. I mean, that's typically, hey, if I support this, or I can't support this, let's carve this out. But it oftentimes to me, and this is my last question, Henry, this is more of a conceptual question or pragmatic question. It's almost like the left hand and the right hand, they're not aligned. They're not rowing, to use a rowing analogy, they're not rowing in the same direction. Yeah. They're rowing against each other.
Sure. And I agree. And I think really what, we're talking a lot about the actual specifics related to what parts of this provision, increasing taxes, will affect certain types of investments, conversions in Roth, types of investments inside of IRAs and so forth. But I think the two main things that we need to focus on are that I think that this will negatively impact great behavior that we've spent roughly 20, 25, 30 years trying to cultivate among the United States population. And we've finally gotten there. Like, I would even say that it's not that it's just started. We've really gotten there. And we're going in the right direction, and we're about to change that right away. And then if you look at the parts where potentially disallowing investments that might require you to be accredited, I think if you really dig deep and actually double click all the way through, you're going to find that most of these are actually direct real estate and infrastructure related investments that are hyper local, and basically, instead of money that otherwise would have gone into the publicly traded stocks of Fortune 500 type companies, are really probably funding projects that are within 25 miles of the person who's making these investments. I mean, that's what I see in probably more than half of the deals that we have that are in that 1/3 that I just talked about of the threatened investments.
Well, certainly a lot for people to think about, noodle on, and think about what makes sense, not only for them, but
Sure.
also, you're absolutely right, in terms of, we've got auto IRAs, we've got MEPs, we've got all these things that we're building, and you don't want to undo that infrastructure. Henry, we're going to have to leave it there. Always a pleasure chatting with you, and want to wish you a great rest of your weekend, and we'll talk to you again very soon.
Thank you very much. Appreciate it. Thanks for having me on.
Thanks, Henry. Great to see you. Thanks for sharing your perspective. And when we come back, we'll take a look at some of our best segments for the week. You're going to want to stay tuned right here on BRN Weekly. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you over 50? Would you like to get up to 33% more income in retirement? Then call now for this free book, Annuity Do's and Don'ts for Baby Boomers. This free book reveals little-known secrets about annuity strategies that will help you make the right choices before buying an annuity. Call right now for your free book, and as a bonus, we'll also throw in a free annuity rate report, both absolutely free for calling Annuity General today.
Call 800-504-8194.
Welcome back. This week, I spoke with MillionAcres.com editor Deidre Woolard about the impact of the jobs housing mismatch to real estate affordability. Let's take a look.
You and I have talked before about rents going down during the pandemic, a little bit in New York, a little bit in San Francisco, kind of dramatically in San Francisco, but they're back. Rents are going back up. People are going back towards cities. And at the same time, you have people moving to the Sun Belt. So you've got a couple of different things going on. A lot of conversation right now is happening about how long remote work will last, when people will go back to the office, and if some of the movement that we saw during the pandemic into what they call the exurbs, the things beyond the suburbs, essentially, is that going to last? Should home builders be building there? Does it make sense to put more infrastructure there? There's so many questions about the future of work and how that connects to how we live, really. You're talking about Nevada, Texas, Florida's in the mix too. no tax states. That's part of the draw there for some of the businesses. But the appreciation in Austin has been through the roof. I looked at the median sales price according to the Austin Board of Realtors, $470,000. It's an increase of over 34% in the last year. I mean, it's unsustainable for the people who wanted to live there. Phoenix, another market that's gone crazy in the past year, their median sales price is now $405,000. And so all of this is above the median price for the country. And it's turning the places that people were going to for affordability into being not so affordable, but still far, far below the median prices in California. Part of it is just about building housing where it's needed. The inventory levels are still really low. In Austin, for example, there's 1 month of inventory. I know inventory in Charlotte remains low. And when inventory is low, there's bidding wars, prices go up. We keep waiting for that to change. It's probably not going to change incrementally within the next year. It'll go up and down a little bit, but part of it is that people are staying put because there's nowhere that they can go that's, affordable. And so that's part of the concern. So really, we have to build more housing, and we have to build it where people are moving to. Lumber has been an issue. It's stabilized a little bit in terms of pricing, but what you mentioned about the supply chain has been this huge issue. Anyone who wants to get a refrigerator or a stove is waiting months. It's been just ridiculous. And so you've got, last I checked, around 50 ships off the coast of California, outside of the port of Long Beach. So right now there's a run on shipping containers because the shipping containers aren't getting offloaded, so they're not getting put back into use. So people can't find enough shipping containers to even move things across. That's become a concern. And so places like Lowe's, for example, are trying to order big now for the holidays, trying to get as much inventory in and around their stores as possible, which then puts more pressure on industrial real estate, logistics, having enough warehouses nearby. It's fascinating. It's taken a year to sort of untangle, and I think it's going to be another year until we fully untangle all these issues. And it may end up influencing how a lot of big companies and manufacturers think about how they do things in the future. In a normal time, if there's a supply chain issue happening between two countries, you can go get your goods made somewhere else. That's not really possible right now. And so that's part of the problem, is that there isn't some like a safety place where you can go and get your goods made and get them on time.
And I also spoke with Fund Intelligence's Randy Plavaika about integrating alternative investments in 401k plans. Let's take a look.
I think right now is a really interesting point too. As we've seen alternatives kind of creep more into the traditional asset management space, a lot more retirement-focused managers have been starting to take a look at it as to how can we get this in here. One manager I'll highlight, and by no means is this the only manager doing it, as I've said before, but AllianceBernstein is a really interesting case in that they have a really good lineup of target date funds, but they've also been really focused on building their alternative capabilities in recent years. Most recently, they've been doing a little bit of investments over there, building it up. As you may know, they are backed by Equitable, which is a very large one-time insurance company owned by a UK parent. But at this point in time, it's like Equitable and AllianceBernstein are really trying to build out alternative capabilities for AB. What this means, at least on the target date side for them, right? They might be able to bring in an approach wherein they're basically investing a sleeve of the target date fund in private alternatives. By no means is it seamless under the current SEC regulations and guidelines. But there is ways to achieve that exposure. We've actually already seen it kind of done. There's this one firm called Mission Square Retirement, formerly known as ICMARC. Their asset management arm, Vantage Point, has been doing a really good job, I would say, of bringing this in. And they were planning on basically incorporating private alts over time. So I've spoken with Wayne Wicker over there, a wonderful CIO, and he's basically informed me in prior conversations, not as of late, but they're basically looking to achieve a very slight exposure for private alternatives over time. And that includes, I believe, private equity, private credit. Obviously, there's a little more color there in terms of like what they're looking to get into, but they're trying to figure out a way to do it that is both making sense for the participants, making sense for the advisors, and then ultimately opening up the DC world to a bit of the private alternative world that there wasn't access to before. I think one interesting avenue I've seen taken too is more incorporation of real estate, which I know is not that controversial of a private alternative class, but bringing that in. There's a couple asset managers already out there that are already basically very well entrenched in the real estate space atop their traditional mutual fund and ETF offerings. And they're starting to basically look at how we integrate that into the retirement picture. I think what's really interesting, right, is that similar to your point, everybody's looking at fees. How do we keep it cheap? How do we keep it affordable? Does this mean we go all passive, even though our expertise is inactive? Figuring out kind of the blended approach, I think, is really interesting from my perspective too, because it doesn't seem like there's going to be one route to get there. It's very similar to the retirement income conversation. I think everybody's trying to figure out, I guess, one part of the puzzle to make it all happen. But by no means is there going to be a roadmap or a blueprint to getting there. I think most notably right now, it's very much available, or private alternative exposure is very much available through custom offerings, right? When you're designing one-of-one portfolios for whether it's a big client or a retail client with a lot of money to flex, it's very possible to already add this type of exposure. The basically where it gets a little bit, I guess, fuzzy, right, is the risk. Because at the same time, there's always the fiduciary liability that a lot of advisors are balancing. You never want to be in that sort of trouble, right, where you're basically putting your own practice at risk just for the sake of achieving some slight exposure to private alternatives. Again, if the clients really want it and the clients have expressed that, of course, you have to kind of fulfill that. But it's a balancing beam. People have to walk that and make sure that you're doing it right, and not just taking a leap of faith and hopefully that your private equity investments pan out for your retirement portfolio. A lot of times, as we both know, innovation in terms of like portfolio design takes a couple years to come to fruition. So although you and I have been talking about managed accounts for a long time, and private alternative exposure has been just as prominent a feature in those conversations, I think like basically seeing widespread adoption hasn't quite happened yet. I don't expect it to be an avalanche, right? I very much expect it to be like a slow build over time, if it ever happens. But I think over time there will be more demand for it, right? Because people at the end of the day want a really well-balanced portfolio that can survive anything the market throws at it. Clients at the end of the day want what's best in the market. Oftentimes cost is one of the only factors there. But if they can get the best with only a little bit of risk or a little bit more added risk, they're happy to, bite a few basis points worth of cost just to make it happen. I think all that being said, I think the environment's still very fruitful. I'm hoping to see some more development. Oh, good. Sorry. Go ahead.
No, go ahead. Finish your thought. I jumped on you.
At the end of this year, I'm continuing to have a lot of conversations with asset managers in the DC space and the traditional space that are working on stuff like this. It's very much tied to the retirement income conversation too, which is kind of, I won't say odd, but to me interesting, right? Because at the same time, they're trying to solve the very complex needs of retirement income. They're trying to solve for basically bringing private alternatives into the DC picture. It's by all means, it's, a very similar conversation, but it's always interesting to me that, all these plates they're seemingly balancing at once. I think annuity integration is probably top of mind. I wouldn't say in terms of like their actual general account portfolio, when they're building that, they're thinking, oh, we've got to put X% toward private alternatives. Otherwise it's not going to be a great offering. I think any amount, of exposure can make a great offering, right? At the end of the day, as long as your equity and your fixed income are well balanced and well exposed on a national or global basis, looking from the lens of a US portfolio, you're going to do well. In terms of like annuity integration, though, I do very much see those conversations happening on the variable annuity side. There's very slight noise around it with the registered index linked annuity space. Obviously more so with the variable though, because that's kind of where you can have a little bit more fun, if you will, with design, where you can have, slight more risk. But at the same time, when you're selling these to clients that are looking for annuities, you can be ultra transparent with what's in the offering. And that's what it's going to boil down to, right? Is I think with insurance companies, especially, it comes down to how transparent they want to be with the offerings. Clients will always value transparency over a lot of other things. And I think bringing private alternatives in can sometimes muddle that or make it a little bit more opaque. And just, I guess, maybe sort of tempering that is what it's going to look like, right? I haven't seen any annuity providers yet roll out and say that, private alternatives are the future of their product development plans for the next some odd years, but they're all working on it. I think at this point, everyone that I've spoken to, at least in recent, has been trying to figure out, and it usually, like to our point previously, is happening alongside that retirement income discussion of how do we make something long lasting that will survive different market cycles, and private alternatives present a route to surviving some of the worst throws in the market.
That wraps up this episode of BRN Weekly. Have a topic of interest, somebody you think we should talk to, drop us a line. And don't forget, for all the information in retirement markets, technology, personal finance, so much more, check out today's edition of our daily newsletter, The Morning Pulse. We're back again tomorrow, this time for BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news for the week. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited? And do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.